All right, good evening. Welcome, everybody. Today is December 6th, and this is our fourth time doing this pathway to home ownership using HUD184. I'm excited for you guys to be here. And I'm more excited about this one today just because there's been some enhancements that are going on with this loan program, and which I think is incredible because once you listen and learn about it, it's a no-brainer. Most of the times, right? There's always that exception. Because we're always looking at numbers, and Marsha's really good at analyzing the numbers to make sure that this is the best option for you. So with that said, we're going to start off with Marsha. Marsha, you should have the host capabilities. I've been in business with Marsha a few years now. She's actually my go-to HUD184 person, and she's very good at what she does and very experienced. So with that said, Marsha, go ahead and take it away.
Okay, I'll see if I can get this to work right the first time. Hopefully. Okay, so Adrian, can you see my screen then that says HUD184 program overview?
I can. So you have to hit the share screen down in the bottom.
I thought I did that. So you can't see it?
I don't.
Oh boy.
So go to share screen and then double click on the screen you want to share.
Okay, try again.
There it goes. Something's happening. Okay.
Okay. All right.
So
let me.
Yeah. Just start the presentation and you're good.
Okay. So did that work this time now?
There it is. Go ahead.
Okay, great. Okay. So yes. So now you see the screen that says HUD184 with the house on it. Okay, good. Thank you. So basically, just to tell you a little bit about the program, the HUD184 program or Section 184 program, you'll hear it too. I kind of call it both, is a program that's actually been around since 1992, and it's continually funded. Sometimes people think the money comes and goes, but it doesn't. The money is around year-round. The program gets budgeted once a year, but it's been around since 1992 to help Native American families purchase homes. Originally, it was set up because there was no money or funding available for Native American people to purchase on tribal land. But the program expanded to where you can use the program for, in Arizona, especially anywhere in the state. So it does not have to be used just on tribal land. And some of the benefits to the program are that it's got a very low down payment, and I'll go into more detail on that. And it's got very flexible underwriting. And again, it can be used on and off native land. It can be used for new construction homes. It can be used to rehab homes. It can be used to purchase an existing home, of course. And it can also be used to refinance a mortgage. People are real curious about that right now because the rates are higher than they were a year ago. But if rates do come down in the next year or two, which they're expected to, just know that that's a feature of the loan as well, is that the loan can be refinanced. So I'll tell you a little quick about me. I've actually been in lending for over 35 years, since 1986. So that ages me, of course, but I've been in the mortgage business really almost since I got out of college. I actually am mortgage or licensed in several different states. So if you have friends or family that want to purchase in another state, I still may be able to help them. But I do what I do because I love what I do. I love helping people get into homes, especially first-time home buyers. I love to work with people getting into their first home. I did live in Arizona for over 35 years. I don't live in Arizona any longer, but so I do everything remotely. I actually live in Colorado. Love Colorado. This time of year, I kind of miss Arizona and the sunshine, but I played golf today, so it's warm enough in Colorado to play golf. And then the company I work for is called VIP Mortgage, and they've been around since 2006. And we've been participating in the HUD184 program since 2014. So we've been doing the program for 8 years, and was kind of instrumental in bringing the program to the company. So what we'll talk about is now the program itself. So basically, who's eligible for the program? So any Native American who is a member of a federally recognized tribe is eligible for the program. And you have to prove eligibility with either a tribal ID card, or some tribes use a what's called a CIB, which is a certificate of Indian blood. So you do have to be able to prove that you're a member of a federally recognized tribe. Can only have one HUD-184 loan at a time. So it means you can't buy a home and then use it over and over again. You can use it again as long as you have either paid off the original HUD-184 loan, or if you sold the property and then freed up that loan to be able to use it again. And then at least one person that's on the mortgage has to be that enrolled member. But you can have another non-tribal member on a loan. So if you have a significant other or co-signer that needs to help with a mortgage, they do not have to be a tribal member. Just one person that's going to occupy the property for sure has to be a tribal member. And then, like I said earlier, the entire state of Arizona is eligible to use the HUD-184. There are limits on how much can be borrowed, and that does depend on the county. And of course, I know probably most of you or all of you are in Pima County. In Pima County, you can borrow as much as $420,680. If you happen to be up in Maricopa County, it's a little higher. You can borrow a little over $467,000. So again, that's the amount that can be borrowed for the program. It's not the purchase price. Somebody has a large down payment, they can still purchase more than that, but that's the amount that can be borrowed. So again, uses of the HUD-184 loan, it can be used to purchase an existing home, including a manufactured home. It can be used to purchase what we call a 1 to 4 family residence. And I know Adrian will talk a little bit more about that as well in his presentation. But basically that means a single family home or a duplex, triplex, or fourplex. It can be used to rehab a home. So if you find a home that you like, but it needs work, that can be done within the mortgage when somebody's purchasing a home, or even if somebody was refinancing a mortgage and wanted to do some work on the house, they can actually pull money out to do that work on the home. And then why should you choose a HUD-184 loan or Section 184 loan? So the Section 184 loan has a very low down payment. It does have a down payment. It's not a down payment assistance program. It's just a mortgage, but the down payment's only 2.25% of the purchase price of the house. So if we, just to give you an example, if you were looking at a home that's say $300,000, the down payment on that loan or that home was only a little over $6,700. Most other loans, with the exception of a VA loan for veterans and a program called a USDA loan, which is only in rural areas, those are zero down loans, but this program has then really the next lowest down payment of any mortgage program. Interest rates are based on market rates. So my little presentation there says low interest rates, but it's basically market rates. So the rates are comparable to other loan programs, other low down payment loan programs. Manual underwriting, what that means on this slide is that the program looks kind of more hands-on. An underwriter actually looks at all of the paperwork. It's not a loan that's only approved by a computer system. There are loans, in fact, the majority of loans, the computer has to say yes or no on the loan, but the HUD-184 program allows us to write a lot of explanations. There's a lot of flexibility that the underwriters have as far as if somebody maybe had some credit issues, we can explain those away, or something funky with income. So a lot of times we do lots of letters for the files that we put in with the Section 184 that explain things. If somebody had overdrafts in their bank account, we may have to explain what happened. But basically, the program allows us to do that and then to get the underwriter to actually review that information rather than, again, just having a computer say yes or no. The program does have what's called a guarantee fee and annual mortgage insurance. The guarantee fee is 1.5% of the loan amount, and that's financed into the loan. And that's basically to fund the program so that it can be continually funded and so that there's money there. And then, Also, you pay what's called mortgage insurance, which is 0.25% annually. And that is, again, part of the monthly payment. And that also is the lowest mortgage insurance of any low down payment loan. So there's FHA loans, there's conventional loans, the USDA loan program I mentioned, they all have mortgage insurance unless you're putting a large amount of money down. And the HUD184 program has the lowest mortgage insurance of all of those. So it helps keep the payments lower than most other loan programs. And then the program does monitor what lenders charge so that we can't make sure that we're not charging more than what is market in the market areas. There's no adjustable rate mortgages for the HUD184 loan. They're all just 30-year or 15-year fixed rate loans. And really 99.9% of the loans we do are 30-year fixed rate loans. The program is not credit score driven. So a lot of programs you'll hear that you have to have a minimum credit score of 620 or 640 or 660. The program does not say you have to have a certain credit score. That does not mean that credit's not important. So we do look at credit history, payment history is important. So again, just because we say there's not a credit score minimum doesn't mean that credit isn't important. There's no maximum income limits. There are programs that are out there that are, a lot of times there's assistance programs. A lot of those have maximum income limits, meaning you can't earn more than a certain amount of money to be eligible for the program. But again, the Section 184 loan has no limits. You could make $1 million a year. And if you were buying a house in the right price range and wanted to use the Section 184 loan, you can do that. So it doesn't limit the program based on income. And then you can get gifts from family members or tribes. I know the Pasquayaki tribe, the Tohono O'odham tribe down there, often help members with money to assist in down payment or closing costs. So those are great resources. So then we're going to talk a little bit about the process of the mortgage and getting qualified for the mortgage. So the very first thing that you'll want to do when you're thinking about buying a house is getting pre-qualified. And basically that means contacting a lender, hopefully me, either over the phone or we can do applications online as well. And we talk through a lot of information to kind of determine how much you'll be able to qualify for a mortgage. So we're going to look at your credit. We're going to talk about job history and income. We're going to talk about down payment. We'll talk about closing costs and how much money is really needed to purchase a home. And then based on income and what are called debt ratios, and what a debt ratio is it's a percentage of your income that can be used towards the house payment and all other debt payments. And debt payments are going to consist of credit cards, car loans, student loans, child support or alimony, if you owe the IRS money, those things all get factored into debt ratios. Things that don't get factored in that people often think about are childcare expenses, cell phones, utilities. Those things don't factor into that debt ratio just from for qualifying purposes. So the Section 184 loan is designed so that we can't put somebody into a home that's more than they can really afford to pay. We can't allow all of your debt payments to be more than 41% on typically of your monthly income. So there's programs that actually allow your debt ratio to be up as high as 55 to 60%, which is crazy. So again, it's a program that's designed to put somebody into a home that they really can afford, not just qualify somebody for the most home that they could possibly buy. So basically, once we have our initial conversations or initial application, there's a whole bunch of documents that we have to get copies of, and I'm going to go through a list of that as well. But we'll get those documents, and then basically, once I review those, I make sure, again, of how much you can qualify for, and then there's a form that's used in Arizona called a pre-qualification form. And I fill that out, and I send that to you and to Adrian. And basically, that lets Adrian know, and the other side, so the seller of a property, know that you have talked to a lender and that that lender feels that you are qualified for a mortgage, so that you don't get under contract on a home and then get turned down. And as Adrian knows, I am very careful about my pre-qualifications. I'm sure I can say this with 100% certainty that Adrian and I have not ever had somebody turned down on a loan once they've been under contract on a house. So I'm very careful. I don't want somebody to get under contract and get halfway through and then get their loan declined. So we're very careful about that. So once you have that pre-qualification letter or form, then you and Adrian are going to go look for a home. You're going to find the home that you want, and then you are going to write a contract. And that's where Adrian will come in, of course, showing you homes and writing a contract. And then once you actually have a contract accepted, that's when we can actually lock an interest rate in. So we can't do what we call locking the rate, meaning we're securing the interest rate. Rates are subject to change until you have a contract. But at the point that where that contract is accepted, we can lock the rate in. And then basically there'll be paperwork that we'll do, lots of paperwork that you'll sign, which is primarily done electronically these days. And then with Adrian, most people will do a home inspection. It's certainly not required for the program, but it's certainly highly recommended. And again, that would be a conversation that you and Adrian would have about the home that you're purchasing. Once you have gone through that home inspection and we know that everything is looking good, both on the loan and on the property, then we would order an appraisal on the property. And that appraisal is really done to let us as a lender and you as a buyer know that the property is worth what you're paying for it. So once we have that and we have all of the documentation for the loan, and again, I'll go through documents that are going to be needed, we send everything to an underwriter, and that underwriter gives us an approval on the loan. And so once we have an approval, then we're actually ready to close. So we're ready to make you a homeowner. So we again, as a lender, draw up a whole bunch more documents, and we send those to a title company where you'll go and actually sign a whole stack of papers that are for the closing. And then again, those documents come back to us as the lender, we review them, and then we do what's called funding the loan, which is when our money hits the title company for the mortgage, and any money that you might need as the buyer or money from the tribe goes to the title company. And then once we have funded and all the money is there, the title company records the deed of trust, it's called. And then you officially own the home, and Adrian gives you your keys. So what kind of documents do we need? We need lots of documents. So remember, we're loaning a lot of money with very little money down. So as I said initially, we have to have a copy of a tribal enrollment card or CIB. If it's a tribal enrollment card, which most of the times it is, we have to have the front and the back. We have to have a copy of a driver's license, pay stubs covering the most recent full month. And when we say full month, if somebody's paid every 2 weeks, we actually have to have 3 pay stubs, because otherwise we might only be getting a portion of the month. If somebody's paid twice a month, then we actually just need 2 pay stubs. And those are things we always make you aware of. We have to have W-2s or 1099s for the last 2 years, which of course in this case is 2020 and 2021. Federal tax returns for 2020 and 21. We do have to have the most recent 2 months bank statements for all bank accounts, checking, savings, money markets, any bank account that you're moving money in and out of, we will ask for statements on, and we have to have full statements from the bank. And of course, most banks, you can pull those online, but they do have to be complete statements. And then it's sometimes helpful to actually have statements on any retirement or investment accounts, because sometimes even if you're not using that money to purchase the home, just those added assets can strengthen the loan when the underwriter looks at it. If you're renting currently, we do have to verify rent history and payment history. So we have to cover the most recent 2 years. If somebody has lived with family, and I've kind of got this at the bottom, but if somebody's lived with family for a portion of the 2 years, we typically have to have a letter from that family that you've been staying with, indicating that you've been living there, because we do have to address where you've lived for the last 2 years. And then that per capita letter, there are some tribes around the country that actually have money that their members get monthly or quarterly or annually. If that's the case, that's documentation that we have as well for using for income. There can definitely be other documents other than what's on this list that we could need. If somebody was divorced and gets child support, or pays child support, we have to have documentation on that. If somebody had a bankruptcy recently, we might have to have paperwork on that. So this isn't an all-inclusive list, but it's a pretty complete list for in most cases. And then this screen or this slide shows a little bit about a comparison of some different types of loans and why the Section 184 or HUD-184 loan might be the best program. And so we've kind of compared just the down payment and the mortgage insurance with an FHA loan, which is a fairly common loan, a VA loan, a conventional loan, and then the HUD-184 loan. So the down payment, excuse me, just grab a drink of water. So the down payment on the HUD-184 loan, which is, you should have it listed at the top, but unfortunately I have it listed at the bottom, is 2.25%, as I said earlier. FHA loans have a down payment of 3.5%. Now, VA loans do have a 0 down. So if somebody is a veteran, that very well may be the best program for them. And then conventional mortgages basically typically are 5% or more down. So the next little column just shows a kind of the ballpark down payment using a $300,000 purchase price. So you can see the FHA loan requires a down payment of $10,500. The VA loan again is 0. Conventional loan, you're starting at $15,000 down or more. And then the HUD-184 loan is 6.75 or 6,750. So again, other than the VA loan, which is again only for veterans, the HUD-184 loan is typically going to have the lowest down payment. And then another big factor in the HUD-184 loan is what's called mortgage insurance. And mortgage insurance is something that protects lenders against default. So if you default on a mortgage, that means the lender doesn't take the full brunt of that default. The government steps in and picks up part of the loss. So FHA loans, the mortgage insurance is high. It's in this case 0.85%, and that's per year. So in this $300,000 example, that's $212 a month, every month for the life of that mortgage that's paid. Again, VA loans are unique, don't have mortgage insurance. Conventional loans, the mortgage insurance varies, and it varies depending on credit score and down payment, unless somebody puts 20% or more where there is no mortgage insurance. But the mortgage insurance on the low down payment conventional, so at the 5% down mark, is probably about double what the HUD-184 loan mortgage insurance is. And you can see again on that bottom, it's the HUD-184 loan, the mortgage insurance is only 0.25% per year, which is just a little over $62 a month. And that does go away eventually. Again, with that FHA loan that's at the top, that $212 a month never goes away. It's for the lifetime of the mortgage. So definitely not the preferred type of mortgage if we don't have to use FHA. So what makes up a mortgage payment? So people often hear a term called PITI, which stands for principal, interest, taxes, and insurance. So the principal and interest is the part of your mortgage payment that actually pays the loan down and off. And then you'll have taxes, which are property taxes, and those are specific to the property. You'll have insurance, you'll have the mortgage insurance, and then you'll have home insurance. So you're always going to carry insurance on your home, just like you do on a car. And that's going to be part of your monthly payment. So you'll never actually have to pay your own tax bill or your home insurance bill because it's always built into the mortgage payment. And then we also have listed on their homeowners association. So if you purchase a home that's in an association, you'll have dues that are paid. Those are not really ever truly part of your mortgage payment. The mortgage company will never pay your HOA dues, but they are treated as part of the payment for qualifying purposes. So that's why we have it listed there as part of the monthly payment. Oops. And I guess I already got to the end. Does anybody have any questions at this point? No questions. Adrian, do you want to pull up that
Yes, let me put
other document?
back down. Let's see.
Did I leak? Is my screen gone?
Can you see it now? Can you see it now?
Yes.
I have a quick question.
So,
I think there's a question.
yep, go ahead.
Yeah, I'm sorry. So I'm not licensed yet, but I just have a quick question as far as, do we have to get like a special certification for this HUD 184, or just because we're with the company, or how does that work?
Well, you don't as a realtor.
You don't as a realtor.
Oh, I'm hearing an echo on when I talk.
I'm hearing an echo on when I talk.
So, I had to get certified and trained to do the program. You as a realtor don't have to have any certification. It's certainly helpful to know about the program, which is why it's a great idea that you were listening and learning about it. And of course, I'm happy to give you any information, but you don't have to have any special certification to do the program. I did to be able to originate them. Does that help?
Yeah, I'm
So-
sure that answers this question.
What? Sorry.
Yeah, I'm sure that answers this question, and
Okay,
I'll
good.
talk to you more about it.
So the last little piece of information that I didn't have put into my presentation, but that we wanted to touch on is, again, because of the interest rates having risen over the last years, there's a lot of talk about what are called buy downs. And the most common buy down is called a 2-1 buy down. And basically what that is, if we're looking at an interest rate, and say today the rate's 6.5%, and rates again do vary depending on credit scores and purchase prices, but using 6.5 as an example, and keep in mind this example on this form is based on a $400,000 purchase price of a home. So we wanted to show an example of what can happen or how much the payment could maybe change the first couple of years to help somebody get into a home and maybe feel a little bit more comfortable with the payment the first year or two. So on this particular example, the principal and interest payment at the full interest rate. So if the interest rate is 6.5%, the principal and interest payment is $2,508. And again, that's only the principal and interest, like we talked about on the other screen. That does not include property taxes or home insurance or mortgage insurance. But what we're seeing a lot now is sellers willing to fund what's called a buy down. And what that means is that they're putting money aside that's going into basically a bucket where money's being held. And so on that very first line, it actually shows the interest rate being at 4.5% the first year, which means the payment is only principal and interest is $2,010 per month instead of $2,508. So it's about $500 per month less of a monthly payment. Now that's only for the first year. And then the second year, the rate goes to 5.5%. And again, the payment then is about $2,253, payment again being principal and interest. So again, you're still about, $250 less than the full payment. And then in the years 3 through 30, the payment is at that $2,508. So what can happen with that is that it can help you get into a home with a little bit lower payment. You still have to qualify for the full payment. So you're still qualifying at the $2,508, again, plus the taxes and all the other things. But it lets you feel more comfortable in the home the first couple of years. And again, with what we think will probably happen, and we don't have a crystal ball, but odds are we'll see the rates hopefully going down in the next 12 to 24 months. So let's say you got into the home and the first year you only have to pay 4.5% on an interest rate. And then a year from now, the rates have dropped back down to say 4.5% or 5%. At that point, we can refinance the mortgage and hopefully get that loan mortgage payment down on a permanent level. But again, there's no guarantees. We don't have a crystal ball. But that is what we're seeing a lot because we do anticipate rates going down in the next couple of years sometime. So it just helps people get into that home and feel a little bit more comfortable with that payment rather than jumping into that payment that's $500 more per month. So I think that's it on that, Adrian, unless you have anything to add on that.
I think that's good. I'll go ahead and when I do my presentation, I'll share a couple of things about that.
Okay.
But
Okay.
this is incredible because if you're already on the fence, or you're looking to purchase, not only can you purchase, but now you're going to have these savings where it says buy down funds, these savings per month. That's extra funds that normally what you would have to come out of pocket. So $500, that's $6,000 a year that you can do what with? You can pay down credit with, you can help pay down your truck or car. So there's so much you would now have control of because of this. So let me share my screen now, my presentation part. Let me know if you could see it, Marcia.
Yes.
You can see it? Okay.
Yes.
So my name is Adrian Moreno. I want to thank you guys all for being on the call today. And hopefully you guys get a lot of nuggets and just more of a better vision and understanding of what's out there when it comes to purchasing a property. My goal today is to help you understand the purchasing part of it. So I am with Amod Realty Group. This is the first time I'm actually saying it in front of somebody. So Amod Realty Group, I'm excited. That's going to be my team's name, which is brokered by eXp Realty. And we're going to talk about pathway to home ownership. So let's go to the next slide. So I just wanted to give you a quick background about myself, just because I have a passion of what I do here and with the program. But I grew up in Old Pasco. It's a traditional community of the Pasco Yaqui tribe. So I grew up there. My mom still lives there. I'm always there. I was there earlier today. So that's, where my heart is and where I was raised. I did go to the University of Arizona, and I studied what's called accounting and finance. And I give credit to Brianna, your uncle Brianna. His name is Rolando. He's one of my best friends. And I didn't know when I went to college, I didn't know what I wanted to do. I just knew I loved numbers. And I asked him, Rolando, what are you going to do, man? He's like, I'm going to do accounting. I go, what's accounting? I was already going to U of A. I didn't even know what accounting was. And he says it deals with numbers and businesses. And I was like, all right, I'll do that. And I'm so glad. And I have to, put my hat off to Rolando, because without him and asking him and him kind of telling me what accounting was, I would have never steered in this direction. So got accounting and finance degree. And my first main job was at Casino del Sol. I was a marketing analyst. So I was in the marketing department there, did it for 6 years, and I analyzed all the numbers. So if you ever go to any casino and you would put your player's card, that's the data I would get and extract and basically create models and give it to the CEO, to the directors. And that's how we did a lot of our promotions. That's how we invited VIP players back. So that was my job. And I did that for about 6-7 years, and it was time for me to go on to, and I went to the government side. So I went to a very fast-paced type of environment, and I went to the tribe, and I worked in finance, and I was their fiscal man. I started off as an accountant and ended up as a fiscal manager. But in those 6 years with the tribe on the government side, I was assigned to the housing department. So I got a chance to work with the tribe. I helped fund the education center there. There on the reservation, I helped get funding for the center over there, the health complex in Guadalupe. So doing creative financing. And then when Marcia's a loan officer, and she started doing this program in 2012-ish, 2013-ish. And in 2008, I was doing this loan. So I learned about this loan, and I was like, man, people need to know about this. People need to be aware of it. So from 2008 to 2010, this is what I did. I did what Marcia did, right? I did that for 3 years, and I absolutely loved it. And I'm still an advocate of it, as you're going to see. But in 2010, when we had to get a license here in the state of Arizona, I said, now's my time to jump on the real estate side. And in 2010, I became real estate licensed. And also, Brianna, your grandfather was my first client ever, so I helped him and with the program. So I love this stat here. I just did my numbers a few days ago, and since 2010 to present, 24% of all the families I've ever served in my real estate career is used the HUD-184 loan. So 24%. So that means 1 out of every 4 families I help use this program. So I share that just because I'm a huge advocate. And I just want people to know that I just don't say it's important. I just don't say it's an incredible program. I'm a living proof of and breathing, and I'm always calling Marsha, I need this. What about this? Right? I'm always trying to learn more. This is my 12-year portfolio, and it's just to have you see truly that I'm in the trenches every single day out there working. And it shows here that in HUD-184, 24%. And I just don't do HUD-184. I've helped families with FHA. Some of them are tribal too. That at that time, FHA was better, let's say, than the HUD-184 or conventional cash, right? So I've helped families if they have cash. VA, I've helped veterans before, USDA. So I've helped a huge, all array when it comes to trying to get finance. And then it says buyers versus sellers. 2 out of every 3 families I help are looking to buy. And 1 out of every 3 families I help are listing and selling their house. So I share this just because I have a lot of different experience, but it's not about that. It's about, how do I buy a home? What do I do? Where do you start? How do you get financing? How long does it take? So these are questions that today's meant to do. And so how do you buy a house? Well, you need money. Where do you get the money though? Well, either you could have the cash to buy that home there that I'm showing there, but how many families have cash? How many families right now have 300,000? How many have 200,000 just laying there, right? And even if you did, it's probably not a smart investment to do when you start understanding about leverage and the power of money, right? So majority of families, they finance. And so that's where Marsha was talking to you about the different financing ways. So now let's say that you're ready to buy. The first thing you do is get pre-approved, right? You get with Marsha and she sits down with you. And if I could promise you that if HUD-184 for whatever reason isn't the best program for you, she's going to tell you that, right? She might say, you know what, as much as HUD-184 is powerful, this is the one I recommend because this is what it will do and this is how it would benefit you. And she's still going to give you that option though, right?
Okay.
So when it comes to, okay, I'm pre-approved, now I got to find a house. Well, where do you want to live, right? How many bedrooms do you need? Do you need 2, 3, 4, 5 bedrooms? Number of baths, features? Do you want to be in a gated community, not gated community? Is school district important to you? How big is the lot? Do you want some families need a large yard. They want kids to run around. Some don't. Some absolutely hate HOA, homeowners associations. Some don't, right? So this is what's important. What is it that you need? Square footage, a certain size property. Do you want a single story? Do you not want a 2-story? Do you want a pool, not a pool? So what is important to you? And so that's what we get together, we brainstorm, and then we start looking. From the time we meet and we start shopping, this is the phase we're all in right here. You guys are all right now in this phase where it's in the pre-contract stage. This is when you're getting pre-qualified. Once you get pre-qualified, now guess what? We're gonna start looking at houses. And at that time, if there's something you like, now we're gonna start making and negotiating offers. And the minute we have a willing buyer and seller, we come to an agreement that we create a contract, right? That process takes about 25 to 35 calendar days from start to finish. So from the time we go under contract to the time you get your keys is around 25 to 35 days. We can do it sooner. We could do it longer. And Marcia and I just helped a family in 21 days in 2 months ago in October. From start to finish, we got it done. And so we're here to work. We know the process. We had assistance from the tribe, so we had to incorporate a third party, down payment assistance. So we were working, and it's very important that we're on top of our game, but also as buyers that you guys are getting Marcia documents, that you're getting to the tribe the documents. So we created a great team here. So it takes about 25 to 35 days. So we go under contract, boom. Day 1, day 0, we're under contract. There's gonna be a thing called earnest money that you guys have to understand that. Guess what? That you guys are gonna have to have it's a good faith deposit where you guys put some money, you take money out of your pocket and we give it to a title company. And the title company is going to hold on to that. And roughly you're going to put about 1% of the purchase price, right? And that goes towards your down payment down the road. That goes towards closing costs, whatever. And I'll explain that at one of the last slides. But we have to provide a down payment. So we go under contract, and if the house is $300,000, you're roughly going to want to come up with $3,000 out of pocket that we're going to give to the title company. Title company, they're going to hold on to your money and they're going to protect it. And the title company, I like to say they serve almost as a police. They don't represent the buyers. They don't represent the sellers. They're there to protect you and make sure when you get a hold of that property, the day you get keys, is that you don't have to worry about anybody coming back and saying, hey, you owe us for this, or any liens or any of that. All that is squashed. So the day you get your title, the day you get your keys, you have a clean title and you have no worries about it, right? So title company is going to hold on to your money. I don't hold on to it. That $3,000 is held by title. We go under contract. Guess what? We have 10 days. We have 10 days to do inspections. This is negotiable. So if it's a property that needs some maybe fixer-upping, guess what? Maybe we ask for 15 days, right? And this is the time where we could ask for anything. And in these 10 days, we're going to get a home inspector. A home inspector, like it looks there, it's almost like a doctor. This is the doctor of a house that says, you know what, Mr. Inspector, I'm going to pay you this money and I want you to find everything wrong with my property here that I'm going to buy, right? I want to know what's wrong. And I also want to know what's good about it. So he's basically giving it a good physical. And so by the time he gives you a final walkthrough, which takes about 2 to 3 hours for his inspection. At the end of the inspection, he's going to take you in a final walkthrough and says, hey, this is where your clean out is. So if it's ever clogged, your toilets are clogged, this is where you would go and you could run a snake. He's going to show you anything that's damaged. He's going to talk to you about the foundation, if there's cracks in it. So he's taking you around and showing you places. This is the turnoff. So if the water line breaks, you come out here and you turn it off here, right? So he's giving you an education about your property. And in that, he's going to give you a report, right? We're also going to, if you want, do a termite inspection. And so that's to see if there's any termites there. We're going to do an HVAC. Let me see if we're going to do an HVAC. You know, if you want somebody to come service the HVAC, you know, if you're buying a house that has a pool, you may want to get a pool inspector to take a look at it. And we're going to get a roofer to go and take a look at the roof. So all these here are third-party costs. What does third-party cost mean? Third-party cost means that you have to pay out of your pocket that's not associated with the down payment. That's not associated with the closing costs, which again, like I said, I'll talk about it at one of the last slides. So this is a third-party cost, meaning you're out of pocket. If we, for any reason, retreat and back out of this deal, these are the only fees, majority of the time, that you will not be able to collect back, right? This is almost like, I just want to do my due diligence, right? So this is what you're going to do. This is your due diligence to make sure that you want to buy that property. And let me give you an example. Let's say you're buying this property for $300,000. Would you rather buy the property, get the keys, first day the water heater breaks, and now you have the minute you have the key, that's your responsibility, versus would you rather buy the house for $300,000 and have the opportunity to do your own due diligence and have that home inspector say, you know what, there's something wrong with this water heater, we need to get it checked out, right? And this also gives us an opportunity to go and say, once we have our inspections, we go to the buyer, we go to the seller and say, hey, Mr. Seller, as much as I was willing to buy this property for $300,000, we didn't know this was broken, this doesn't work, and this needs to be repaired. If we want to move forward, we're now asking that you repair this, right? So there's a whole contract we go through there, and I'll sit down and share more of that, but that's more of the process. Also, in the first 10 days, this is the time when you have to decide whether you want to live in this property or not. So even before we do the inspections and you're paying out of pocket, maybe the first few days you're driving by that property at night or maybe in the morning. And if there's something you don't like that you see there, guess what? We back out of the deal. We cancel the contract, and that $3,000, that earnest money you gave to the title company, guess what happens? You get it back, right? So this is an opportunity. You do your due diligence. You can look to see if there's any basically anything, right? If there's and I give you a list where you can check, you do your due diligence and you check if there's adult predators, right? Child sex offenders, all that stuff you get to research and see if you want to, if there's crime that's important to you that you don't want to be there, you take a look at that. So we provide that for you. The next thing we also have to do is the appraisal. What is the appraisal? Marcia mentioned that, but this is also a third-party cost where Marcia's going to say, hey, we need you to give us a credit card or we need to pay for this. The cost is roughly around $500 to $650. And this basically gives proof to Marcia when they're giving you the loan that the house you're buying is really worth $300,000, right? So what does that mean? Well, it protects you and it protects the banks, because the banks will only let you borrow. They're only going to give you a loan, whatever's the lesser of the two. So if the house appraises at 300, you're golden. What if the house appraises at 310? What happens? You're golden. You know you're buying a house that you already have equity in, and that's what happened with that deal in October, right, Marcia? We not only did 1 days, they walked in with equity because it was worth more than they were that they bought it for. But let's say this happens. Let's say it's worth only 290, right? What happens there? Are you on the hook? No, we can now go back and say, hey, Mr. Client, as much as we wanted to buy it at 300,000, it's not worth that much. It's only worth 290. Here's the appraisal to prove it, right? The seller at that point has a couple options. They could either say, no, I'm not going to do it, right? Where then we have to either come down and pay that extra 10 grand, or what I'm going to do with you and for you is I'm going to negotiate and say, well, why not, right? You're trying to sell a house that's worth 200, 300,000 and it's only worth 290. So that's where negotiation comes. So in this market right now, there's a better opportunity to negotiate that. 6 months ago to maybe 2.5 years ago, we really couldn't negotiate this, right? Because there was 10 offers on the table. There was 10 buyers on the table that when it came to this, you were almost having to pay out of pocket that difference. Versus now, because houses are sitting on the market a little bit longer, about 30 days, 31 days, and this is being recorded December 6th, the seller's most likely going to drop it. In the past, we've been able to, where they say, well, okay, well, we'll drop it 5, right? And you guys come in with 5, and we come in with an extra 5,000. But appraisal issues, we're pretty good with that. That's not it really doesn't become a problem, but that can happen, right? But this is a third-party cost. And I say these are contingency. So the state of Arizona, the contract was written for the buyer. So it protects you guys in all aspects. It's really, really, really hard to not get that the money from the title company back, that $3,000 in our example. And so there's a lot of ways that you as buyers can back out of the contract legally. So then that way, guess what? You get your $3,000 earnest money back. The only thing we can get you back is that appraisal if it's already been performed, and any of the inspection fees. So this is pretty much the process of the transaction. Once we're done with the appraisal, it's pretty much you're just at this point only working with Marcia on getting your loan approved, getting the final documents, updating documents, and then we close. So what I wanted to do is, so what is your investment? Well, you got to come in with the down payment. A down payment of 2.25 in this specific example. If you're using the HUD184, if you're doing FHA, well, it's 3.5%, but in this one, it's 2.25%. So on that 300,000, $6,700, $6,750. You're going to also have to come up with third-party costs. These are out-of-pocket expenses that you're going to need. And I would say it's roughly, I would say a little shy of 1,000, but I wanted to be conservative in case you guys wanted to get an HVAC guy out there. On older houses, sometimes you want them to scope the plumbing to see if how the plumbing is, right? So these are all extra costs that you would have to pay. So in my experience, majority of the time it's under 1,000, but I just wanted to be conservative. Closing costs. Closing costs are when you get done, when you close for your loan, there's fees that you have to pay, title fees, there's lender fees, there's all these different fees, prepaid fees, right? And in this market, so I would say it's probably it's between 5 and 7 grand, could go be more. It's based on loan amount, right? But in my experience, what I've seen, it's roughly around 5 grand, 5 to 7 grand. But in this market, we can ask the seller when we're negotiating in the beginning that they pay for this here, right? In this market, sellers being asked to pay, and that's negotiable. The other thing is, guess what? The temporary interest buy down. That's another cost, right? That only the seller can pay, right? So in this market, we're asking them to not only pay the closing costs, we're asking them for the temporary buy down, right? Which is negotiable. So, or you could use I don't want to get too complicated, but just know that all this is negotiable. And right now in this current market, as of December 6th, sellers are aware that they're probably going to have to, they're going to help contribute towards this. And then the earnest money, I just wanted to make sure that we note that this will be used towards your down payment. So if that 3,000 in our example, guess what? If your down payment is 6,750, that means at closing on day 30, day 35, day 25, you're gonna have to come in with a check of $3,750, right? That's what you'll still have to come in with, right? Or if we don't get enough closing costs to pay for that, then we're gonna have to come in out of pocket on top of that. So that's what's gonna be used. If we've been able to get down payment assistance and we don't need all that, you don't have to come in without a pocket, there's a chance some of that 3,000 you'll get back as well, right? So I would say if you are able to qualify for the HUD-184, that you get with your tribe. You go to the housing department and find out what programs there are for you. Like Marcia said, the Tohono O'odham, they have some funds for you, and the Pascoyaki tribe, they still have funds. And we have to still go out. There's an application we've got to fill out. And right now the process is for them, for Pascoyaki tribe, is once we go under contract, we fill out the application and send that in with a lot of the same disclosures that you provide, Marcia. So that basically concludes the this portion today. I want to thank you guys for your time. Before I open it up for questions, I just want to say, please do not keep this a secret. I think, you know, there's a lot of realtors out there. There's a lot of lenders out there that do not know about this program. So if you go talk to another lender, you say, do you do the HUD-184? A lot of times they'll say they have access to it, but they don't know how to do it. You have to be approved to do these type of programs, right? There's certain training that they have to go through to do it. And I will just make sure that you guys, even the real estate, do you know that every single contract that I've done is I have to call the real estate agent that we're making the offer for and say, hey, this is Adrian Moreno, and we're going to submit an offer. And I want you to know that we're going to be using a certain type of loan called the HUD-184. Are you familiar with this loan program? 99% of the time they said no, or I've heard about it, but I don't know how it works. Well, let me explain it for you. And I explain how it works because I want to make sure if there's two offers on the table, that they don't try to discriminate, and because they don't have any knowledge of it, right? They lack the education, that they end up picking another deal because they're good, they're very comfortable with that scenario. Right. So I'm very proactive. I explain to them how it works. Marcia's not afraid to give them a call and also explain it. And one thing I want to point out, and that what I put here for my notes is from when Marcia was talking about, is this is not for low income. I hope you guys caught that. A lot of people think that because it says HUD-184 that it's a low income program. No, it's any kind of income program. Like she said, if you're a millionaire, you can have access to this program. I met a gentleman who's very high up, very influential in the Native American space. He's a tribal member that is very, very successful. And he said, Adrian, I thought this was for low income, so I can qualify for it. Absolutely, you can, right? Leverage money, lower down payment, keep that money in your pocket. Lower mortgage insurance, keep that money in your pocket that you're going to have to pay out there. So, so with that said, I want to thank you guys for coming and joining us today. Any questions that you guys may have that we can answer? And if there's no other questions, that's all, folks. Right? Like, is that Marcia?
Thanks.
All right. Thank you guys for being on the call, and we'll talk to you guys soon.